Well, so they get you with these iPads now where they spin the iPad around. There's 40 people behind you waiting in line, right? They spin the iPad around and like the lowest tip option is 15%. So 15% is the lowest tip option for literally just turn around, grab the beer, open it and hand it to you.
What happened when you tipped $1 a beer? Remember that? You go to a bar and they give you 3 beers, you tip them $3.
That was also for a bartender who at least like poured you the beer or like made you a drink. Like they literally turned around, grabbed it from the fridge, handed it to, like opened it and handed it to you. And they're like, okay, minimum tip here is $3.
Welcome to Drunk Real Estate.
Grab a drink and enjoy the show.
Hey there, and welcome to episode 31 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband. Sorry, guys, I'm hungover. I had the Eagles game last night. It was a tough one, and I'm struggling right now. So, but anyway, this is a special episode because once again, AJ's traveling all over the world. Who knows where he is right now? Some Asian country. So we called up our buddy, Mr. Matt Faircloth, to join us. How's it going, Matt?
I'm great, man. Thank you so much for being here, guys. Such an honor. I believe I was a part of the very, very first Drunk Real Estate podcast when we were doing the Sippy Pecan. I'll sip in a bourbon. And I was trying to convince Jay Scott to run for president, as I remember. By the way, Jay, the door is still open if you're open to that. But would love to have you throw your hat into that one. I think it was
that was literally, I think that ended up being one of the topics on that episode.
It was. We needed to get 1,000 likes for the YouTube video or something like that, or maybe it was 10,000 likes, and you would agree to run. So the timer is still out there, guys.
We should just rerun that episode because that was kind of like our beta test to decide like this was we should just keep rerunning that episode, and eventually, if we do it for 20 years, we'll get enough likes that Jay will
keep it going. I'm going to keep holding him accountable to that commitment he made on the show, on the air.
I heard a rumor though, Matt, that you showed up to Drunk Real Estate and you kind of did a little bait and switch and you're not drinking in January. Is that true?
I'm doing dry January. I asked Jay if I could consume some lovely THC product for the show.
Oh, okay. Are you in New Jersey right now? Because it's fully legal in New Jersey, right?
I'm very close to New Jersey right now.
Just lie. Come on.
See New Jersey from where I am, which is fine, Mauricio, right? It's very close to where I live.
You have anxiety. You have a script. It's okay. We got it.
Yeah, I do. All the time.
Just coming on this podcast creates the level of anxiety that requires a THC.
It does. I was anxious about being on the show, and so I went and got a script. So yeah.
Well, we appreciate you having you here. Mauricio, how's it going over there, man?
What's going on? I heard Messi scored a few goals at the game. It was pretty awesome.
Yeah, 40. Messi had 42 goals at the Eagles game. It was great.
Messi's the word for that game.
Dude, I'm glad we got the boys back in. I feel like the boys are back in town. So looking forward to this today's episode, even though it's freaking noon. Well, 12:45.
Can we just touch the game real quick, Kyle? Your thoughts on the Eagles implosion? I can give you
it was a litany of issues, and we lost AJ Brown going into the game, and we were already on a tough streak there.
What happened? Why? I didn't read. Why is he hurt? What happened?
Oh, his first catch of the game, week 18, just got smoked. Went down. He was down on the ground I was watching that game. He was down on the ground for 10 minutes
in the Giants game.
But yeah.
But Kyle, but you didn't really watch that much of the game though. You were infatuated with Kelsey's wife or something that was sitting in front of you. I mean, that was really what you're doing. You didn't really watch much of the game.
We were sitting next to Jason Kelsey's wife.
Yeah, she was front row, 3 rows in front of us.
And Kyle was a bit distracted.
Well, no, it's just because
soon to be Taylor Swift's sister-in-law.
Yeah, exactly. But no, because it was a big deal though, because it was I'm pretty sure it was Jason's last game. He was retiring. And so that she was going through that moment, and I had to go through that moment.
She needed somebody to console her.
I don't know if I could. She's 6 feet tall too, or something. Though she's crazy tall. Yeah. So I was it was kind of emotional for me. I'm not gonna lie. I had to go through that moment where I retired from hockey in the off season. I didn't know I was retiring. Kind of just a bunch of things happened. And I was I'm retiring. And so I didn't know I was playing my last game. Ashley wasn't at my last game, so she was kind of upset that she didn't get to watch me. And so we were literally just watching them go through that moment. And he came over and said hi to his family. It was his wife and his dad were there. And so, yeah, Jay and we were with this other guy, Steve, who's another from Philly, transplant to Florida, went to the game with us.
Lives on a boat down by the river.
Exactly. Steve's awesome. I love Steve. But I could tell they were grumpy with me because I didn't want to leave. I'm like, I'm waiting until Jason Kelsey comes over here. Like the game was over, people were leaving. I'm like, I'm not missing this moment. So it was bittersweet that, you experienced that moment, but it was a tough loss. And I don't, with all the injuries and we had some problems with play calling and stuff. I don't think we had a Super Bowl team this year anyway. So might as well.
Are you on the bandwagon of the head coach is the problem for the Eagles? I listened to the Eagle Sports Radio partly just because it's just curious. These guys are out of their mind, I mean, it's
always much easier to get rid of coaches than it is players, right? So, it's easy to jump on them, but no, like he had 2 brand new coordinators this year, offensive, defensive coordinators. Sometimes it takes some time to get in that. I think.
Yeah, I was gonna say I'm already done with this. I'm like I already checked out.
All right, that's fair. That's fair. But for the six other Eagles fans that were listening to, they're finding this interesting. Marisa, what are you drinking over there?
I am drinking something new today because it's a special occasion. I think it's called a tequila sunrise. I think that's what it is. It's like tequila and OJ and stuff, but it's a special one. It's a very unique blend. This is a virgin tequila sunrise, and it's a very yummy actually.
So wait, I'm gonna suffer through a drink right now, being like crazy hungover, and you're over there drinking orange juice.
No, it's a tequila. It's a virgin tequila sunrise. Let's call it what it is. Don't rename it. We're not going to, let's not change definitions. It's a virgin tequila sunrise. Okay?
Yeah, I was going to say, I used to be a bartender, and that is not a tequila sunrise if you don't have grenadine.
Yeah.
Ooh, calling you out.
Yellow and red.
Ooh.
It's a virgin screwdriver.
There you go. Yeah.
There you go.
Or a virgin mimosa.
Yeah.
It's a virgin mimosa.
A virgin mimosa.
All right. Well, now I'm grumpy that I got this. I made Jay go out to the back of the truck and grab a Coors Light from our tailgate from the night before, so that I could drink today. So now I'm feeling a little grumpy about that. And Jay, you're drinking that too, aren't you?
No, I'm drinking same. I grabbed something from what we were tailgating with last night. So it's a Blue Moon Light, citrus wheat light, 3.6 carbs per can. I like it. But wait a second, before we go any further, I think you did Matt an injustice. He didn't get a proper introduction. So I'm going to give Matt the proper introduction. So not only was Matt like the first, this is the gang's all back together from the very first episode of Drunk Real Estate, before it was Drunk Real Estate, when it was like a segment of another show that we were doing
that nobody was watching, that other show that you guys were doing that nobody watched.
So I was telling Kyle, the analogy I have is like The Simpsons. The Simpsons premiered like as a little skit on this comedy skit show called The Tracy Ullman Show. And the show sucked. But the Simpsons part is 5 minutes. Okay, fine.
Is that what we do when we want to change it? Okay, thanks. I need to know that now.
It got spun off.
Protocol here.
It got spun off, and 35 years later, it's awesome. And so the 4 of us are doing the same thing. Anyway, Matt is a multifamily syndicator. Matt is a fellow Bigger Pockets OG. And Matt is the author of this awesome book called Raising Private Capital, which if you've checked it out, great. But even if you've checked it out, you got to check out the second edition because the cover is better.
Is that the first edition or the second edition that you're holding up?
It's a unique cover as well, Jay. There's no book ever with a cover even similar to it.
Yeah, well. you had to be careful. If you go into Amazon and you type in Raising Private Capital for real estate, the top two results, I think they were designed by the same cover designer too, right? It looks like it was.
I think one of them was designed by Matt's cover designer, and then the other one was ripped off.
Oh, we're calling that out. Okay, I know, getting spicy.
We can all look at the release dates on the books.
I like Jay's getting spicy. Last episode, he started calling out syndicators who might have had some trouble with the law. Started making some.
And this one, we're going to be calling out some other people in this episode.
Oh boy! All right, well let's get into it because I got a flight to catch back to snowbound Philadelphia. All right, job market resilience has been the talk of the town, and the unemployment rate has been sub 4% since January 2022. But the tech industry has been a different story, producing 2 years of massive layoffs in IT companies, with 262,000 workers laid off in just 2023 alone. 2024 was set to be a turnaround for the tech industry, but then it started off the year with Google. Their parent company, Alphabet, just laid off hundreds of workers right off the bat, right at the start of the year. So Jay, it seems like the tech industry has already kind of seen their own little mini recession, but it has little effect on, overall jobs and the economy as a whole. So what's going on? Is it actually going to start being a bigger impact that we think, or is it kind of just its own segment that we don't have to worry about?
Well, we wouldn't be talking about it if I wasn't a little bit worried about it, but maybe not for the reasons that everybody thinks. So let's start with the reasons why. Obviously, layoffs in the tech industry are not a good thing. So there are about 500,000 tech companies out there. It makes up 10% of the U.S. GDP. So like tech's a big thing. It's the second largest industry as a percentage of GDP in the country, behind I think healthcare. We're talking about 8 million, 9 million tech employees out there, and so it's a big industry. We saw about 150,000 layoffs in 2022. We saw about 260,000 tech layoffs in 2023. And here we are 2 weeks into 2024, and we've already had 5,500 layoffs. And I think, Kyle, you mentioned Google. I think they had 1,000 of those. And Discord had a bunch of them. And so we're seeing a lot of tech layoffs. Now, when we started seeing tech layoffs about a year ago, I think it might have been on this show, it might have been on the previous version of Drunk Real Estate, but I made the point that I come from the tech industry. And the way the tech industry typically works is that during good times, during good economic times, tech companies just overhire. They hire anybody. They get butts in seats, and they just try and grow as quickly as possible. And their goal is to make sure that other companies aren't taking the good talent. So they'll overhire people they don't need for roles they don't really have. Then when the market starts to soften, things start to turn down, because they can't really do layoffs until then, because layoffs signal that there are issues. Layoffs signal that maybe the company's having trouble or running out of money. So they don't do any layoffs even when they've overhired. Then when the market starts to soften, they see this as an opportunity to basically say, okay, we're going to do layoffs. But those layoffs tend to be, we're going to cut 10, 15% of our lowest performing staff. They're basically culling the herd. They're not really doing like tactical layoffs to save money or for austerity reasons. It's just an opportunity. The market's getting soft. We want to signal to our shareholders that we care about their money, and we're going to cut costs by cutting 10 or 15% of our workforce. And it's really just they overhired for years before, and now they're cutting the lowest 10 to 15% of employees. So the fact that we're seeing tech layoffs for the last year or two hasn't surprised me. In fact, I would have expected it. The bigger concern I have, and I think this is,
but Jay, didn't you just say there though, like they do it in recessionary times? We haven't had a recession, so wouldn't that be surprising that they're doing it outside of a recessionary time?
Well, I mean, to some degree, we haven't had a recession. It started back in 2020 when the pandemic hit. And remember, they're not necessarily doing it because of the recession. They're doing it because the recession gives them cover to do it. It basically, the shareholders aren't going to beat them up for these layoffs or get concerned over these layoffs. They're going to say, you're doing a good job. You're taking care of our stock and our shares and our capital. And so I think there's enough public sentiment out there right now that things are not great, even though we talked about this last week. The data says they are, but public sentiment says things aren't great. And so there's a lot of cover to do all of these layoffs. And so, again, I don't think that's a big surprise. And I don't think it's a big issue. The bigger issue is at the same time that tech companies are laying off thousands or even tens of thousands of people, they're spending billions of dollars on AI technology. And my big concern is that all of this money that's going into AI is ultimately going to drive technological process that's going to allow them to long-term replace those employees that they're laying off. And so that the next time we get into an economic expansion, economic good times, instead of going out and doing tons of hiring again, these companies are basically going to say, we don't need to hire all these people because thanks to AI, whether it be generative AI, whether it be basically AI that does like sorts and looks at data it much faster than humans. Whatever type of AI it is, it's ultimately going to replace a lot of these employees that the company otherwise would have needed to hire. And so my concern is that not only are we seeing a culling of tech employees today, but this could be a long-term trend in the future thanks to AI. And I think everybody knows that AI is eventually going to have a big impact in the tech industry and probably every other industry. But my concern is this could be the start of that, or signaling the start of that process.
But we've had this discussion before. Won't it create jobs as well? Like I would say, when I was coming into this segment, I was thinking that AI has been saving the tech industry. Because if you look at someone like Meta over a numerous rounds of layoffs all the way up until last May, had cut about 25% of their workforce. And now they're hiring like a lot of them back. And that's all because of this AI push. And that, like, to me, that's almost an indication that you bring in AI. Yes, some people are going to lose their jobs because of AI, but then they're going to be creating new jobs because of it as well. We talked about before with these prompt engineers and like these new types of jobs that had never existed before, but are now going to have to exist.
Yeah, or they end up getting a job in a different field. I mean, just because you lose X amount of jobs doesn't mean those jobs go away forever. I mean, throughout history, you've seen technology come in and replace a particular trade or whatever, and it's not like those jobs disappeared. They just have to. There's an adjustment period, obviously, and they're going to go somewhere else for a while. But yeah, for sure. And I mean, AI for sure. We have talked about this on the pod before, where AI is going to be, I think we all agree, kind of a deflationary thing long term, right? And I think that's one of the concerns in general, especially if you're into the monetary thing and you're devastated and freaking out of deflation.
I'll let you do it if you want to. Can you describe for our listeners, Mauricio, what that means by AI being a deflationary thing?
Yeah, I mean, if AI is able to do the job instead of needing 10 people to do a particular job, you only need to be able to do, you can do it much quicker and more effectively with less people, then that by definition is deflationary.
Yeah, it's going to allow companies to create their products for a lot less money because they don't have to pay 10 people when they just have one machine doing it. And that means they can drop prices for those products. And so we could see prices start to drop. And I know everybody out there is probably thinking, that's awesome. I want prices to go down. Prices going down is exactly what we need. But the problem is, and this is kind of one of those things that we don't talk a lot about in economics until it's a real risk, but deflation is a really bad thing because while everybody's happy that, okay, tomorrow the price of whatever product is going to be less than it is today seems like a good thing, the issue becomes, well, if you're thinking the price is going to go down tomorrow, you're probably thinking the price is going to go down even more next week and next month and next year. And so instead of buying that product today or tomorrow or next week, you keep holding off buying it. And when the whole country stops buying stuff because they think prices are going to continue to drop, that basically destroys the economy. And we have this snowball effect and the spiraling effect where the economy just goes into the tank or down the tubes because everybody's stopped buying stuff because they're convinced things are going to be cheaper if they wait.
Yeah, I mean, that's a nice theory, but I mean, in reality, that doesn't always happen or rarely happens. I mean, iPhones get cheaper or better every year, every twice a year they come out with a new iPhone. That doesn't stop you from going out and buying an iPhone or your TV. Kyle's 150-inch TV that he's got at his house, that keeps coming down in price. But you want that TV now. You want to watch the Eagles game now. You don't want to wait till next year to watch the Eagle game on the bigger TV. So yeah, that sounds like an interesting. I mean, what deflation really is, I think, a bad thing. When you say quote unquote bad thing, is for governments, because when you have debt, right? When you have that debt, you want to inflate the currency so that debt becomes cheaper and cheaper and easier to repay. If you have deflation, the opposite happens. That debt becomes more and more expensive. That's like
inflation's the hidden tax, right? Like, so it was kind of the dirty little secret when we had 9% inflation. Well, just look at how much taxes were collected by the government when that was going on. And
that's exactly right. So even though you're getting in a deflationary environment, your purchasing power is going up. The powers that be cannot tax that. Like if my $100 now is able to buy more cartons of egg, I know we talked about eggs last week, but if my dollar now allows me to buy more eggs than it allowed me to buy last year, I've got more purchasing power, but there's no way for the government to tax me on that additional purchasing power. Then much rather me have $1.10 make more money and have more purchasing power that way, because then I can actually tax you on that additional 10%.
I think that going back to tech layoffs, right? Number one, it has been one of the biggest growers in America over the last say 5 years, whatever. So I think that these layoffs mean one of two things. I don't know, my crystal ball is broken, but it means one of these two things, right? Number one, AI came into the scene quick, and it's coming in fast, and it's changing a lot of these companies, and they're seeing that to be where the air quote future is, as we're discussing here, right? So I think that option number one is that these companies are realizing that they're tooled the wrong way, meaning like their staff is facing the wrong direction, because the staff that's in these companies were not built towards building out Facebook, Amazon, Google, towards an AI solution, an AI-ifying America and the world, right? They're seeing that and say, okay, we need to retool and make Google, Amazon, Facebook, Dropbox, everything, Instacart. We need to make these companies more AI centric. And so that means that the staff that we have are no longer serving us. So we're going to be retooling and redirecting the long-term vision for the company. That's number one. And that would cause layoffs if they're seeing a redirection of the company. The second option is tech in a lot of ways has been the grower, and in some ways been the indicator of where it's, as Jay said, it's a 10% contributor to the U.S. economy, that these layoffs are going to domino into other companies having to tighten up their belts, because that is also could be what they're doing. Is just, when companies lay off, it's the easiest way to make your bottom line show great. Is like, hey, look, our bottom line in real estate, our NOI looks great, because really what they did was they just peeled off a bunch of unnecessary staff. As Jay had said, they're just holding staff, as like almost like a staff bank, like a land bank we would in real estate. They're just, keeping talent just in case, right? So maybe they're letting a lot of that go because they're seeing where the U.S. economy may be going. And that could domino effect down into other industries. We might start seeing in oil and gas or in healthcare or in other places to start seeing companies get lean to show bottom lines. And that's a lot of times the beginning of a recession.
And companies that get lean too, like the tech industry now, this software as a service has become like the predominant model for tech industry, right? You basically pay monthly fees in order to get access to some software service. Well, if you think when things are going poorly, what's one of the first things that people are going to start cutting, right? Like we pay for all these monthly things for Yardi Matrix, Red IQ, like all of these data services, and there are cheaper options and there's other ways for us to get this stuff, but they're very convenient. They work very well. We have our systems integrated into them, so we pay for them. But like if times get tough, like maybe all of a sudden we're not going to shell out $25,000 for Yardi Matrix. We're going to pay $3,000 or for each individual market instead of the national. We're gonna cut down a little bit.
Where there could be AI-based solutions to those things. Like for us, we use CoStar, right? So I might, if there becomes an AI-centered solution that's able to go and look into public record, because not for nothing, that's what a lot of CoStar is an aggregation of public record and market research data. But there's maybe an AI tool.
And brokers who are snitches and tell on what your purchase price is in Texas, even though it's a non-disclosure state.
Yeah. We've all gotten those phone calls. Hey, I'm from CoStar. Just want to collect some data from the sale you just had. Like, yeah, I know. Now I know how you guys are doing it, right?
I think that AI is a big part of it, and tech layoffs is a big part of it. We've been talking about the big company tech layoffs, and one of the things that I've kind of alluded to on this show a number of times over the last 6 or 8 months is that there's a lot of risk, not just in the big public company space, not just 99% of tech companies are fewer than 500 employees, first of all. So certainly there are some big companies, and when Google lays off or Meta lays off or Microsoft lays off, it's a headline. But again, 99% of companies are small companies, and a significant percentage of those companies are VC backed, meaning they get venture capital money, they get money from investors. And typical small tech company, when they get a VC investment, it's generally for somewhere between 18 and 24 months worth of investment. So that company expects that they're going to run at a loss while they grow. And that money that they just raised is going to last them 18 to 24 months, at which point they're going to have to have gone out and found money for the next 18 to 24 months. And so any given small tech company is generally run in these 18 to 24 month cycles. The problem over the last 2 years, 24 months, is that VC money has kind of dried up. And a lot of VCs are not investing in these small companies. They've got literally hundreds of billions of dollars of dry powder that they could invest, but they're just not comfortable investing as of yet. And so we have all of these tech startups, literally $500,000 tech startups that are potentially needing venture capital, and they're not getting it. And those that raised venture capital 18, 24, 30 months ago, that are now running out of capital, are not going to get re-upped. They're not going to get additional investment. So what are they going to do? They're going to have to make the capital that they have left last longer. How do you do that? You lay off people. You cut expenses. And so what we've been seeing in the venture-backed tech world is that there have been a lot of layoffs over the last year and a half, because these companies realize it may be 2025, 2026 before they can raise capital again. And so they need to make that 2 years worth of capital last 3 or 4 years. So that's actually my biggest concern. And I know when we talked on our predictions episode 6 months ago, I predicted that, like, if we have a big recession, the impetus is going to be small tech companies that basically are all going out of business. And so that goes along with this whole tech layoffs thing, but it's something that's not talked about nearly as much as like the Google's laying off 1,000 people.
Yeah, and the tech industry in general is kind of a tough sledding going forward here, because they're under a microscope too. Like the FTC is like doing a like really trying to prevent these major mergers and really have them kind of tying their hands on what's the options for the exits here, right? Because if you're a small startup and you want VC backed money, that VC backed that money, they're going to want to know that they can exit. And one of the major exits is being acquired by other companies and mergers and things like that. And all of these companies are under scrutiny with the current governments. It's tough for a VC to say, hey, like I'm not willing to invest in this thing for 25 years. Like I want to put my money in, I want to see you go 10x, and I want to get my money out. And if they can't do that, then it'll be tough to raise money from these VCs going forward.
Jay, does it make sense in the future for companies to do this oddball, crazy thing called cash flowing? Right? You hear all these companies talking about burn rate. Everybody's talking about, well, our burn rate is like we're burning through 100,000, 200,000, or forget it, millions, right? On a monthly basis. And you start projecting how long this tech startup can survive before it gets another injection of VC capital. So it's really like you've got a little bomb sitting here, and let's figure out when it's either going to go off or go public. So is there a chance that these companies can start just operating below their expenses are less than their income, and they're able to survive that much longer? Is that possible, or is that just not a thing in the tech space?
100%. And I think we're going to start to see a trend over the next couple of years of bootstrapped tech companies that are basically, they're raising money from friends and family, or they're using their own capital, or they're building a product quickly to start generating cash flow and get profitable very quickly. But there's a reason why VC investments are often referred to as growth capital. It's an opportunity for businesses to grow very quickly. And in the tech space, there's a lot of advantages to companies growing quickly. One, it's good for tech employees. If I can go from a 2-employee company to a 2,000-employee company in a couple of years, I'm going to fill a lot more jobs. I'm going to be able to feed a lot more families than if it takes me 20 years to get to 2,000 employees. It's also good for the U.S. economy. We need companies. We need these unicorn companies like Uber or Airbnb, or all these other companies that we hear about every day that are these billion-dollar companies. We need them because it allows us to maintain a competitive advantage over other countries out there that are competing with us in the tech space. And we need to continue to innovate. You look at a company like OpenAI. If OpenAI had to bootstrap and couldn't have raised hundreds of millions of dollars, how much longer would it have taken for us to have created all this AI technology? And would a China or an India or some other country out there have beaten us to the punch? And now they're leveraging this technology to grow their economy faster than we're growing ours. So there's a lot of advantages to helping these small companies, at least a bunch of these small companies, grow very quickly.
And that's their business model. I mean, that's the whole thing. I mean, if you're looking for cash flow, then go buy a multifamily apartment building, right? Or do a cash flow business. I mean, the whole idea of a venture capital firm is to go find companies that are not going to worry about cash flow. They're going to reinvest every penny, and then they're going to be short. So we need more capital to reinvest even more.
That's actually a great analogy there, Mauricio. When you want to talk about comparing it to, let's bring this back to real estate, like cash flowing apartments, that's one investment, but you could also invest in ground up development. And it's not that much different than investing in a startup, right? Ground up development takes 18 months, 24 months. You're not getting any cash flow along the way. You're throwing all this money up front. It's all getting spent on developing this property. And at the end, usually the business model is to turn around and sell it. There's a few people that will build and hold, but in general, they will spend that 24 months building it and then turn around and sell it to the person who wants to hold it, just like a startup that's going to build and get to cash flow and then look for some public or acquisition or something like that. So I don't think it's that much different.
Let me just tell you I think the big difference is usually if you're a venture capital firm and you're investing money into, first of all, you're investing money into multiple projects, your expectation is that if you invest in 10 deals, 7 or 8 of them are going to fail. Like you wouldn't do that in a development deal. You're not going to say, "Oh, I'm going to invest in 10 development deals, and I think 7 of them are not going to make it out the ground, and we're going to lose money." They're expecting the one or two that actually work.
But they're expecting 10x.
That's right. The one that does work is going to 10x or 50x, and then the other 7 are going to lose. But net over a 10 or 20 company investment, they're going to make. That's the business model. And to Jay's point, we want that.
There's a better analogy here. So I think you guys are both off on your analogy.
Just because it's your analogy does not make it a better analogy.
No, the fact that it's a better analogy makes it a better analogy. The fact that it's mine is just common sense.
The only way we're getting a better analogy is we get David Green out here, the analogy king.
No, I mean, think about it. Matt was talking about bootstrapping. So the equivalent to bootstrapping in our industry, the multifamily industry, would be Matt and I go out and we buy a single family, and then we sell it. We make some money. We buy a 2-family. We sell it. We buy a 4-family. We sell it. We buy an 8-family. Eventually, we work our way up to buying a 100-unit or 200 or 500-unit apartment complex. Well, what we do is exactly what these growth companies, these tech companies are doing, where we don't want to do a single family to a 2-family to a 4 to an 8 to whatever. We want to grow quickly. So what do? We go out and we find investors, essentially VCs, people who give us 20 or 30 or 50 million dollars so that we don't have to go through that slow growth cycle. We don't have to bootstrap. So we're doing the exact same thing.
I don't know, Mauricio. It was a good analogy. I don't think it was better than ours, though.
I think it started off.
Let's analogify the whole thing all the way up and down the street, right? So I think it's like buying a 50-unit apartment building that's got a big hunk of land next to it. Okay. The 50-unit apartment building cash flows, and I take the cash flow from that. And you have to play upside, especially if you're in the tech industry. I get it. You're not gonna blow up on 5 to 10% year over year growth. Jay's right. You need to be, investing heavy and bringing in lots of staff and creating a thing that changes the market and everything like that. So what if the analogy is a 50-unit apartment building, and on that piece of land, I'm going to one day build a 200-unit apartment complex, and I take the cash flow from the asset that I have, and I take that and I use that to fuel my growth. So I'm not relying on future fairy godmother VC money to come in and wave their magic wand and poof me, and all of a sudden I've got enough to build a 200-unit apartment complex. I am bootstrapping, but I've got a machine that's producing a lot of cash flow, not like single family home stuff, enough that I could reinvest and make that next thing happen that much faster. And I think that cash flow businesses, whether it's in tech or in real estate, whatever it may be, are going to be what's going to survive whatever's coming in the future.
So since we're trying to bring this back to real estate, and we do have the luxury of having Matt on our podcast, who wrote the book Raising Private Capital. The whole concept of this was how hard it was to raise capital from VCs right now, because they've kind of been out of the market, and the market's changed significantly as well in real estate right now. And so, Matt, I'd love to hear your perspective on how raising capital has changed over the last couple of years. With, we have high interest rates. You've been seeing the news have been talking about foreclosures, capital calls, all these things. It's a bit of a tumultuous time right now for investors. So how's that changed?
It's crazy. I mean, you get like the Real Deal will broadcast some syndicator that's a renowned person that's in that's getting brought, thrown under the bus or whatever it may be. And then those articles come out, and then our investors are coming to us to make sure we're not that person, right? Like, hey, just so you know, I see that guy getting, the proctology exam over here. I want to make sure that you're not, the wolf in sheep's clothing, that all of a sudden the Real Deal is painting that person to be. So I think that's number one is I'm seeing a lot of existing equity that's in deals that we're in, and also friends that I have in the industry, their equity getting skittish for deals that they've already invested in, just like wanting to make sure that they didn't invest into a house of cards. As there's other, and I acknowledge none of us are building a house of cards, but there's others out there that have, and the equity that I have is coming to us just to make sure that kind of poking at the seams just to make sure that we are sound. So I think that making sure that your equity is informed for deals you have already is paramount. If for anybody listening that's trying to raise capital, be transparent, or even with the investors you have. And then for new deals, I mean, we're in the middle of putting some stuff together today, and conversations from before are not the conversations of the future. It's not value add. We're not really going to talk value add very much with our investor base, because everything we've talked about here, we don't believe that the value add model is going to work very much. So we're talking, again, like broken record, cash flow with our investors on how much we cash flow first day, and what is our plan to increase that cash flow during the ownership cycle. So that's what we're doing, and it seems to be working.
Are you finding it harder to to convince people these days? Because I mean, look what we're up against right now. We're up against people can put money in the bank and get 5% right now.
We're up against a 5% CD. When in our lifetime have we seen that before? I mean, that's what we're up against, and our prefs are not much more than that. What's interesting, Kyle, is equity expectations has not. Everything else is pushed up, but the equity, maybe because the market's just not going to deliver it. Equity expectations has not gone up that I've seen by the percent that interest rates have. By anything else increasing, equity expectations have stayed around the same. So that means that we can yield maybe 15% IRR, the industry average for our world, right? But they can get 5 in a checking account, or in a savings account. And if you buy a marginal deal that's going to produce 2 or 3% year one and year two, and then magic fairy dust happens and you refinance the property and then it produces 10, 11%, the investors are not going to get excited about that. About deals that are doing that they could outperform your year one, year two numbers on something way more conservative than an apartment building investment. So I think it's hard to get them across. It's harder to get them across the fence, for a short answer to your question.
So how are you fixing that problem then, Matt? I mean, how are you? I mean, this is across the industry. Obviously, people are having a harder time raising. So I mean, if you're talking to somebody not as experienced than you and they're having a hard time raising capital, what are if you want to give away your secrets, but I mean, what do you just need to spend more time with them? Do you need to educate them? Like what do you need to do? Do you need to go find more investors? I think Brandon was talking about one of our pods that you 4x your list so that you can, then your conversion rate's going down. Like what are some of the things you're working on to keep that capital?
If you're talking about Brandon Turner, the guy that has like 500,000 Instagram followers, just double and triple, just quadruple your investor list. No problem, right? Yeah. Yeah. It's so saith the guy with 500,000 Instagrams, right? Yeah. So we should all be so lucky. It's not that easy for everybody. So for us, what we've done is we have shifted a bit of our equity stack. So we've gone to like an 80-20 split to increase investor cash flow. We're trying to get away from a pref, because I think a pref is like an awful, terrible thing that used to be involved in just building buildings, and it's worked its way into apartment buildings deals. So we're trying to get away from doing a pref at all. So it's just a straight, if the property makes $1, investors get 80 cents, we get 20 cents. That's it. So that's something that we're doing. And I have been able to convince investors that is actually more of a sound arrangement versus getting behind a pref and forcing a syndicator to make tough decisions because there's like years behind a pref. We've all seen that happen, right? That's number two. And number three, we're just simply, Mauricio, we're just not doing deals. Like, we're not going to force a square peg. And so we underwrote something like 280 deals last year and did goose egg deals. And the fourth thing, we're shifting into new asset classes. So we are under LOI on a deal that is not a multifamily. So it's a deal that cash flows a lot. Day one, it's just a new industry, new asset class for us that we've been researching for 6 months because
Bitcoin?
Yeah, no. Dogecoin.
Dogecoin.
Yeah,
good investment.
Ready to pop.
I thought you were buying a piece of the Eagles or something. I don't know.
They're on sale today, brother.
Yeah.
Yeah.
That was the best time.
You get a good price.
Yeah.
Yeah. I'll give you a hint. And if you play Monopoly, you build lots of greenhouses so that one day you can buy the big red, not an apartment building, but so we're getting into that space and not turning it into an apartment building, keeping it for what it was built to be. So
I've always thought too that and I know some are, just educating too, because, if you're just comparing the returns, you can put your money in in a not a mutual fund, a money market account or buy a T-bill. Yeah. But you don't get all the advantages, right? You don't get the tax benefits, which are huge, even though they're declining a little bit with the bonus depreciation. I mean, I still come across people that don't realize that when you do invest in syndications like this as an investor, you do get those tax benefits. It's essentially the same thing as if you had bought the building. It all trickles up to your tax return. So there are huge tax benefits. I'm preaching to the choir, but in terms of like for LP, I just think in educating them and showing the difference between investing in a T-bill or putting it in your savings account. There's so many other advantages that real estate brings, right?
There is, but I still believe that, and I mean, David Green did like you guys saw it. It's on his Instagram page. It's so great. It's there's a Russian lady, and then he does his impression of her with his Russian accent, which is spot on because she's got this like Lamborghini, and she's bragging about how she bought it for the tax write-off. And then he's like, yeah, well, making investments for tax losses is silly. Like, why don't you invest that for something that has good upside and good yield versus buying a depreciating asset because you can write it off as a tax loss. And I'm not saying that multifamily is that. I'm saying that as long as the multifamily or whatever it is, the sticks and bricks asset does cash flow, the tax incentives that it gives should be like really big dollop of icing on top of that cake.
Yeah, and another thing I've seen people do is people have started to get pretty creative with their capital stacks too, right? Because it used to be that everybody kind of just fell in one bucket. You could take any type of investor. You could take the 70-year-old investor with their retirement money and the young tech entrepreneur, and they all just wanted the best returns. What's the highest IRR we can get? And they would just put their money in that investment because everything was going well. Well, now people are a little bit more wary, and they're starting to wise up to, okay, there's different level of risk and different level of returns. And maybe I have in a capital stack, I said, hey, if I invest in this asset class, the returns are a little bit lower, but I'm higher on the capital stack than the common equity. So I'll get my money back. If something goes wrong, I still protect my asset. My pref is still protected. I might not participate in that 15 plus upside that you were saying, but maybe I'll get 12. And I'm happy with that. 12 is still a lot better than 5 in the bank account. And so there's just more creative options to say, okay, if no longer we have just one investor fits all options, we can kind of play to each individual investor where they are in their investing journey.
And that's why I think it's the biggest thing today in these days is if you're somewhat sophisticated in your business, to offer a few different flavors of ice cream, like, yes, here's a multifamily asset. Here's another thing like a fund or whatever it is you got. Because it's the investors are not all going to flock into a thing because it's hot, because I think people are going to have different investment goals. And I think it's important to have those things going into the air quote new economy, Well,
let me just say, I love the idea of pref going away, not because I love the idea of pref because the one thing it does really well is it aligns incentives. As long as my investors are getting paid first, they know I have the incentive to hit that hurdle.
I'll let you finish, but I would argue the opposite.
I disagree as well. Let's do it. Keep going, Jay.
Okay, so from my perspective, as an LP, and I invest in a lot of deals as an LP. I like the idea that I'm going to hit my 6% or 7% or 8% return before the operator gets anything, because it's going to incentivize them to get me over that hurdle. And that's why we call it a hurdle, before they start thinking about them making any money.
So you started the opposite. Was it just me, or did you start saying the opposite when you did your preface?
He said, "I'd love for the pref to go away, but I also love the pref."
Yeah, you say I'd love for the pref to go away because it's better.
Oh, he's saying as an LP, this is what he would want.
So sorry. I understand why the pref is really important, both for me as an LP and to my LPs. I understand why it's so important and why it's there to align incentives. That said, the reason why I'd be thrilled for it to go away is because, unfortunately, I feel like LPs have been conditioned, and it's really hard to condition them otherwise. They've been conditioned to believe that the pref is equivalent to the minimum cash flow that the property is going to generate.
Guaranteed coupon.
Right. If they hear it's a 7% pref, even though the word pref is pretty clear what it is, even though in our investor presentation we say pref doesn't mean cash flow, what they're hearing is year one, I'm going to get 7%. And if they don't get 7% in year one, their thought is, why did you lie to me?
So I would argue as an LP, I want the opposite, and I think it's like the whole Freakonomics thing and incentives, in that I would rather the sponsor be getting the split along the way, just for the situation that's going on right now. Think about if all of a sudden somebody invested in 2021, bought a property, and they paid a little bit too much for it, and cash flow went way down because of interest rates, and now they're getting to that point that Matt mentioned before, where they are getting so behind on their pref right now, it's almost like you can't even see the light at the end of the tunnel. If I am an LP in that deal right now, and I know that sponsor is so far behind on the pref, what is the incentive for the sponsor? The sponsor's got 12 other deals. What's the incentive for the sponsor to be paying attention to my deal when he knows that, hey, even it doesn't matter how hard I work, I'm never going to catch up that pref, and I'm never going to make any money. He's going to have no incentive to do that. So to me, if it's yes, it's an incentive when times are going great to make more and more money. I'd rather look at okay, what's worst case scenario, and how is the structure of the sponsorship situated so that when worst case scenario happens, then I'm the most protective, instead of saying, okay, best case scenario, it makes the best case scenario better.
I disagree that the pref is an alignment of interest. It is slanting the deck heavily towards the LPs by guaranteeing them a payment first. Whether I know nobody uses the G word, right? But it is perceived to be that way. Even though it's not spoken, most investors believe that at some point, and it is true, at some point the deal is going to owe it to them, right? The deal is going to have to pay them, now or in the future, right? And I think that the GPs need to assemble deals as long as there's not an egregious acquisition fee going in, as long as there's a reasonable acquisition fee going in, reasonable asset management fee, and reasonable profit splits. That's a win-win, right? Because we've all seen deals that are like 90-10 splits plus like a 7 or 8% pref, and magically like a 2 or 3%, like a 3 or more percent acquisition fee going in the front door. Well, now we see what really we've all known back in the day is that deal was assembled just so that GP could get an acquisition fee. Thanks to a lot of the coaches that taught people how to do that and put like big flashy acquisition fees up on the PowerPoint about the money you can make in this business in acquisition fees. So if we look at that, like that's one slant, one direction, but if we normalize the field, the pref really, as Kyle said, it's going to force the GP to sell the deal a lot earlier than they would want to, or than the investors would want to, so that they can get caught up on the pref and just make something and not have to hold their breath forever. So,
well, speaking of coaches and the G word that we don't mention, let's use this as a segment to everyone's favorite uncle is back in the news. Good old Uncle G. But he's back in the news on the other side now. This time, Uncle G is, if anyone doesn't know, we're talking about real estate syndicator Grant Cardone. He is suing John Legere, the former CEO of T-Mobile, for $100 million, saying that he defamed him when he called him, and I'm going to quote here, the biggest bullshit artist on the planet. That was among other insults, but that's just the one that everyone loves running with because they can bleep it out.
Grant should have to go and find a larger bullshit artist to prove that he's not the biggest bullshit artist. Like that should be his full case.
Kyle and I had this discussion yesterday.
Well, let me finish the intro though. So the suit went on to claim that Legere continued to make, quote, wild and crazy allegations that had no validity, proof, or research, and that Cardone's brand and business had lost investors, among other damages. I'd love to hear Jay and Matt's opinion of this, but we do actually have a real life lawyer with us. I know it's not your field of law, Mauricio, but I would love to hear your perspective on this lawsuit and whether it has merit and just what you think in general.
I love it, man. I love Uncle G. Whether you love him or hate him, he has a way to get the headlines. And you're right. I was listening to it this morning. Most of the allegations that you just said about, you're the biggest bullshit artist, or you're not a billionaire, or you're going to be, I think at one point he said, I believe that in the next year, Grant Cardone will be found guilty of fraud. I mean, all these statements were actually made. Check this out. Remember Clubhouse? Remember that didn't really go anywhere, but that's where it happened. There was like a Clubhouse thing with like 100 people in there, and these guys just going at it. And apparently there's some allegations that, and I couldn't tell from what I heard there, but like John had he probably should be part of the drunk real estate pod. He had a couple drinks. He was kind of slurring his words and all this stuff. But he made like, I think it's 5 or 6. I couldn't find the actual lawsuit because the lawsuit, I guarantee you, will actually spell out every single statement that he's alleging is a defamatory statement. I'll give you my 2 cents on the legal side, and then you guys can do all the other juicy stuff. But it's going to be hard for him, right? Because defamation's a little tough to win in general. But what nobody's talking about, and I don't know how it's going to land, but one of the big things that a court's going to have to figure out really quickly is Grant Cardone a public figure or not? Because there's 2 different rules. If you're a public figure, there's one standard. If you're a private citizen, it's a different. He's a big Instagram and social media guy, but he's not exactly a president, a governmental official.
He is a public figure. Explain, yeah, there are people that have less social media followers than he does that are considered to be public figures.
Yeah. So if the challenge that he's going to have from a legal standpoint is that if he is a public figure, not only does he have to prove, which is already kind of hard, that this person defamed him, but it also has to prove that he did it with actual malice. There's a malice component to it, which doesn't exist if it's just me or you. It's a pretty straightforward thing, but opinions don't count. And if you listen to the Clubhouse thing really carefully, John did a pretty good job. Every statement was kind of prefaced with, I believe. So the bullshit one, to me, that's an opinion. You are the biggest bullshit artist on the planet. Is that really a statement of fact, or is that an opinion? I think that sounds like an opinion.
Well, he did call him a fucking con man, too.
But he didn't, though. What he said is that I believe that in the next year, Grant will be found of guilt. I think you are a fake. And then he kept saying, that's my opinion. He kept saying, that's my opinion. That's my opinion. That's my opinion.
Was he drunk though when he was on the Clubhouse thing? Or he just sounds drunk.
I couldn't tell. There was allegations that he'd been, the people there were saying that he had had a couple of drinks. I couldn't tell from the little exchange that you couldn't tell, because you've got to show, number one, that there's a false, I'll just go through real quick, the 3 or 4 elements, and then you guys can talk about them. There's got to be a false statement purporting to be facts. And so that's why opinions don't count. So if you can argue, hey, this was just my opinion, I do believe he's a con artist, I do think he's full of shit, then that's an opinion. He's not. So he's going to have to prove that it was actually a statement of fact, that it was public to third parties, which is clear, and that a reasonable person would have actually understood that to be, a statement of fact. And the last thing is that you've got to tie the damages. So the only one I saw that I think is a material, or that is a misstatement of fact, which was interesting too, because Grant couldn't defend himself, was that you're not a billionaire. Like, hey, you're not a billionaire. He came out and said, you're not a billionaire. He tried to get Grant to confirm that he was a billionaire on the thing, and Grant wouldn't go there. I kind of think Grant was kind of egging him on, trying to get him to say more and more stuff so he could sue him. But then he's going to have to show that statement that, hey, I'm not a billionaire, somehow caused him damages. You've got to make a link between the statement and the damages. But I think the 2 biggest issues he's going to have is, number one, John's going to say these are all my opinions, and opinions don't don't call it defamatory. And number two, if he's if he's a public figure, which I think we would agree or argue that he is, then those statements have to be made with actual malice. And I think that's why it's so difficult to prove defamation in the first place.
My question with this too is like, is this a good move by Cardone? Because doesn't this give him the opportunity, John, to give the opportunity to like tear Grant's like business completely apart, to basically show that he was a discovery for a fraud? Like, is this a good move? Because I feel like this could just open him up. And like, we know these major companies, like they're not fraudulent practices, but there's a lot of practices that are not like well known, where when you have this fund and you need to float to buy one property over here, so he's going to have Grant has a his own debt fund that's his own money, and that loans this fund that money, and it does all these different things to basically get deals done. And they're not illegal, but like if this becomes like public things, all the stuff that he does behind the scene, like I feel like that's not going to look well to the layman who doesn't understand what's going on. And just the same reason with the whole Trump tax returns. Like Trump wasn't doing anything illegal, but if they released Trump's tax returns and it showed that how little he paid in taxes, it's just a bad look. And I feel like the same thing could happen to Grant here if he allows him to go through discovery.
I think he's doing it for two reasons. One is obviously publicity, right? It's a nice, you can call it a stunt or not, but obviously not only is he getting some press, he's like making the rounds, right? I mean, I think this week there's got like 3 or 4 podcasts, people you and I know. He's just calling all of his podcast people and he's getting on these podcasts. So he's out there talking about it. And then it's also, I think, sending a message to all these other people. It's like, hey, if you're going to go out there and trash me, then I'm going to come after you. Almost like the Trump thing, right? Like Trump at some point just kind of intimidates you by suing you. I think Grant's like, let me send a message, because there's so many people that are trashing him, and I think wrongly so, to be honest with you. But like I think at some point you just get tired of getting attacked, and so this is a good message. Hey, if you're going to come after me and start saying that I'm a fraud, I'm a scam, or this or the other, then be prepared, because I'm going to sue you for $100 million. It's going to be a tough one to win. I mean, defamations in general are hard to win.
This is a bad move. It's so funny. I had a buddy just celebrate on Facebook that he's about to interview Grant Cardone, and I have to warn him that like, oh, this could turn into a one angle conversation about Grant wanting to just throw rocks at the lawsuit.
And he's a great interviewer too.
Right. Whether he's a guest or not, right? He's going to make it his show. Whether
yeah, but I was talking about the interviewer that you're talking about. I think I know who you're talking about. He's a great interviewer.
Yeah, well, I know him from GoBundance, right? I mean, I think the world,
and he's such a good interviewer that like it'll be really interesting.
Yeah, no, he's solid. But he sent me that DeRosa superhero thing because he knows I'm a superhero junkie. And that no, he's a great human being. But I got to call him and say, just so you know, brother. But that should be an interesting interview either way.
I'm certainly no like brilliant legal mind or anything, but my first thought, it wasn't my first thought because Kyle and I were talking about this last night, and then I went to bed and it was a later thought. But my later thought was one of two things could come of this that could really help Grant. Number one, once the lawsuit's filed, there's a really good chance that John is not going to continue these attacks. Because it wasn't just that one time on Clubhouse. He's been talking about it a lot recently in podcasts and stuff. And so the lawsuit could be enough for him to say, okay, my lawyers advise me not to keep going there right now. So it could stop the attacks if they're ongoing. So if Grant really just wants to shut him up for a little while and let this all die down, that could be a way to do it. The other thing is potentially if John or his attorneys are at all concerned about liability, it could bring them to the table to say, hey, let's settle, where Grant's whole purpose for settling isn't to make any money off of it. Like, yeah, I'll settle for $100K, but you have to promise not to say anything more about me. So basically keep him from saying anything in the future. So from my perspective, that's potentially what Grant Cardone's trying to do here, is just stave off any future attacks by filing this lawsuit.
But hey, this is a good switch up, because I love rich people suing rich people. That's always great. It's when the rich people sue the little guy, that's when you get pissed off at the American legal system. But two rich guys, let's have it, and let's get the popcorn out. I want to televise. Let's let them go all the way. All right. Any other comments, or are we moving on to the top 10 here?
Oh God, if we have to move, is there a way we can bypass it? If we talk more about this topic, do we skip the top 10? Because
well, aren't you doing it this week, Mauricio, or is this another week where you said you're going to do top 10 next week and you just don't come prepared?
I thought we talked about it I did it last week.
No, you didn't. You played a little either or game. You didn't do a top 10. You just given up. You just admitting that the top 10 is just too hard for you.
I want to change. Can we make it a regular where we do Would You Rather? I thought that was a way more. Guys, if you're listening or watching, if you can drop a comment.
We do that anyway.
Do you prefer the top 10 or do you prefer the Would You Rather? Because if we could do the Would You Rather.
We do both every time.
When we did our original pod with Matt, we did Would You Rather. We didn't do a top 10.
Well, I added the top 10 and we do Would You Rather.
Sometimes you can add sometimes, Kyle, you can add by subtracting.
Jay likes my top 10s.
I don't like the top 10s, but I'm not gonna take sides here. Look at Kyle's face. Kyle's like,
we talked about this morning we were having smoothies together and we were going through the top 10, and you're not going to back me up on the air. Once we get on air, you're not going to back me up. I see how it is.
I enjoy the back and forth that the top 10 causes between you and Mauricio.
All right. I'll skip the fucking top 10 this week.
What is the top 10? Can we riff a top 10 right now?
Yeah, the top 10 was just the number of tech employees laid off worldwide, biggest companies. I thought it was interesting, but
what's number 10?
I'm not going. You can't skip to the end.
I want to hear the numbers. Now you have me.
Number 1, Amazon. Number 2, Meta, Google, Microsoft, Salesforce, Philips, Ericsson, Flink, Uber, Micron, and Dell. Okay, Jay, there you go.
It's going to be a quiet ride to the airport in a few minutes.
Yeah, no shit. I'm getting a cab.
How does a hat go backwards and sideways with a Coors Light? I want to know how the Coors Light gets the hat going sideways.
I'm not drunk at all, but you've created this thing where I feel like I got to turn my hat around every episode now. So
he's angry.
I am angry.
Bring it, baby. Bring it.
All right. I almost don't want to do the Would You Rather just out of spite for Mauricio. Yeah, I'm going to take it. That's exactly what I'm going to do. Would you rather? You got to kill one of these two: Summer Olympics or Winter Olympics. Which one are you killing? Mauricio, go with your game.
Are you kidding me? The Winter Olympics. That's like saying Northern California and Southern California. Northern California is not really part of California. The Winter Olympics are not really part of the Olympics.
Wow,
that's a bold statement there. So what's so good about this Summer Olympics?
That's the Olympics. It's not this. Those are the Olympics. And then they came up with the Winter Olympics. It's the Olympic. The Olympics are the Olympics. Do you remember the Greeks doing the Winter Olympics back in the whatever century this all started?
No, because they didn't have winter coats back then. They were participating in little shawls. That's all they had to wear.
I'm just saying that the Winter Olympics is not really the Olympics.
Okay. All right. That's Mauricio's opinion. Matt, do you agree with that?
That's cold-blooded, and that's hard. That's tough to hear. And you're telling a hockey player that, by the way. But I would prefer the Summer Olympics only because of the environment, the time to go. It's in Paris this year. That sounds awesome, right? Like, I would much rather attend the Summer Olympics. I would much rather watch the Winter Olympics from my home. So the Summer Olympics kind of sucks watching, right?
You like the figure skating a lot?
Well, no. So Mauricio, you'd rather watch 84 different people swimming, like, oh, I'm swimming this way. Now I'm swimming this stroke. Now I'm swimming this stroke. Oh, now I'm going twice as far. Oh, and then let's flip over to track and field. I can run really fast 100 meters. I can run. But I can run fast 200 meters. Oh, but I can run fast 400 meters. Like, they're all the exact same thing. You'd rather watch that than like real sports participating? Or curling. Curling might be the best sport ever to watch.
Isn't that part of the Winter Olympics?
Yes, that's what I'm voting winter all day. And plus Canada comes top 5 every year.
And you said curling is a positive? I thought you were making fun of curling. And I was like, wait, I agree with you.
No, curling's awesome.
Curling is awesome?
Yes, it is so entertaining. I'd rather watch curling than somebody run really fast in 100 meters.
I want you to explain it to me in 30 seconds or less. Explain curling.
Curling's basically darts, but better.
That's not helping you at all, by the way. Jay, bring some sanity to this conversation.
Jay's gonna back me up with a curling. Come on, Jay.
Here's the right answer. As someone who hasn't had broadcast TV for about a decade, I didn't realize the Olympics were still a thing, and I was really happy about it.
So you're taking neither.
If there was never another, don't get me wrong. I'm going to back up Kyle here. I love curling.
Thank you.
And the idea of shooting guns while skiing, I mean, it doesn't get cooler than that. The bobsled or the luge, I don't know the difference between the two, but seeing those guys like the linebackers running at top speed and just seeing if they're going to fall flat.
Little danger factor. These guys are going faster than cars head first on the skeleton.
If I had to pick, I'd rather watch the best of clips from the Winter Olympics. But if it were up to me, they're both past their time.
So when you pick Stranger Things over Winter and Summer Olympics, right?
I pick Stranger Things. I'd pick the marvelous Mrs. Maisel.
Yeah. Let's pick a mediocre TV show. Stranger Things is awesome.
The marvelous Mrs. Maisel over the Olympics.
Oh, geez. I don't even know what that is, but I know my parents watch it. All right. Well, I think I'm going to call it a split decision then, because we had two summers, and I'm taking Jay's win as a vote for winner, even though he said that wasn't an option; it was an either or. So he said winter more than summer. So I'm taking it as a split decision. But hey, let's move on. Let's get some plugs. Matt, thanks for coming, buddy.
You're welcome, brother.
We really appreciate you stepping in for.
I want back in. Let me back in, guys. Audience, vote for Matt to come back on the show at some point when it's not dry January.
Well, hopefully AJ never comes back. I feel like it was our best episodes when he was gone, so
Matt, you want back in? Can you make Tuesday evenings work?
Sure. Not in January, and I'll come on here half in the bag. It'd be great.
We'll check back in on hey, Matt, give us something to plug. What do you got going on right now?
Shameless plug, DeRosaGroup.com, DEROSA Group.com. Go there to hear all things that we're up to.
Yeah, check out some green hotels from Matt coming up.
Red hotels.
Right. Red hotels, greenhouses.
Did you never play Monopoly or
sorry, no, I'm colorblind, Jay. Just feel bad about that. My reds and greens, I mix them up.
Their hotels are different colors in Canada.
Canadian Monopoly, everybody wins. Everybody gets a greenhouse and whatnot. Right.
No, it's actually easier to tell the money apart because it's not all the same color. Thank you very much. Mauricio, what do you got to plug?
I'm still discovering this new app, which is amazing. Instagram. It's been fun. Matt, you don't know this, but I just discovered Instagram about 3 or 4 weeks ago. So it's just Mauricio at Mauricio Raoul. Is that how you say it? Is that how you give your Instagram handle or something? I don't know. At Mauricio Raoul. Come check it out.
Awesome. Jay, what do you got for us?
I'm going to talk about the best book that I have ever read on capital raising. For anybody out there that is looking to raise money, raise capital, which is, as far as I'm concerned, the most important skill on the planet. Told my kids that if you know how to raise capital, you'll always eat. So go please, everybody, check out the second edition of Raising Private Capital from Matt Faircloth.
With the much better cover. I like that one. It's amazing. And if you want to find it, you got to go to Bigger Pockets bookstore and you got to scroll past Jay's 84 books, and he's the one right after that.
Buried behind all of David Green's books and Jay Scott's books.
You can get it on Amazon, but Matt makes more money if you buy it on Bigger Pockets, which is the important thing.
Yeah, so go check that out and skip over Jay's books.
Absolutely.
All right, I'm going to plug my wife. Special shout out to my wife. She's having a rough time right now. I left to go and watch the Eagles in Tampa, and it just so happened right then they canceled school on her, so she's having to take care of the kids by herself, and that's usually my job. So she's having a rough day, but she would feel much better if you guys all went and followed her on Instagram and her other YouTube. So even though she's probably not happy with me, hopefully she'll still let me plug her tonight.
Yeah.
I'm
No!
Badash Investor on Instagram and Badash Investor on YouTube.
Can I just promote your Instagram channel real quick? You and Ashley had the best Instagram video about I'm a real estate investor, and so I like to post like places I go on vacation.
She took an hour trying to convince me to do that. I was not having it.
I watched it like 4 times. I've made Liz watch it. That is hysterical because you guys really broke through a lot of the memes and like just BS that's out there on social media about real estate investing. Like I'm a real estate investor. I go to conferences. I make the profit and loss statement look really, really simple and leave a lot of things out, was brilliant work.
Well, I appreciate that. So go check it out, everyone. Go give her a follow.
And your home gym is badass. If that was your home gym in the Instagram video, that is badass with his own jersey. I mean, who else can put a jersey with their name on it hanging in their home gym? Awesome.
Wow, I do. Matt, you should replace AJ. I love having you on here, buddy. This is great.
I think it's a little conceited to like hang up like stuff about yourself in the background.
It's personally motivating, Jay. If I had a jersey with my name on it, I'd hang it in my home gym.
Yeah, you wouldn't catch me in any of my crap in the background.
If I had a bunch of books that nobody read, I would put them in the back as well.
Whoa! Shots fired.
All right, let's get out of here, boys. I had fun though. It was great having you, Matt. Thanks for coming. My drink's gone though. I got to get the fuck out of this closet. It's giving me claustrophobia.
I'm out of the closet, Kyle.
I'm coming out of the closet right now, live walking out of the closet. I will see you next Tuesday.